All right, guten Morgen, come allez-vous? It is just after 6:30 on Wall Street, 3 hours before the open of trading. It's time to get your global macro on, uncover the best fundamental opportunities across global markets. Oh my goodness, are we risk on? Are we risk off? Well, we got to figure all that. That's long term versus short term. And well, does that matter? Yes, it does. Okay, yes, it does. So, anyways, our AI driven data analysis of sentiment, inflation, employment, GDP, technical trends, open trade positioning, seasonality, and a lot more go into uncovering those opportunities. So, we're going to look at a lot of charts today. One of the charts we need to spend some time on is a smart money tracker because it is the COT report and that was updated. Okay, we want to look at the risk gauges and see how the market responds to Iran attacking Israel over the weekend. Okay, now many people, many analysts on TV are saying, "Oh well, but the Iron Dome shut everything down, so there's nothing to worry about." Well, if I look at it as they were testing the fences. So, yeah. So, anyways, complacency is not a good reaction. But, anyways, we'll take a look at the market and see how the market feels, and we'll keep an eye on it. And if its feelings change, we will know. But this is why trading and investing are, risky and not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term. Never risk money you cannot afford to lose. Let me log in to the site and then into the database. Let's go pro. Let's go pro now. Let's go. QuantBox.co/pro. Okay, yields around 4.5. Okay. All right, that's a little high, but it's not unexpected. Oil coming down, really sort of a buy the rumor, sell the news kind of thing. Part of the reason oil was going up was geopolitical risk. Well, now you got it. Okay. So it's coming down. All right. Well, we're also in the stock market in risk off territory. So maybe that's also playing an impact because then you'd expect slower growth. Or you might say Saudi Arabia's response to the drone and missile attacks from Iran on Israel is to pump more oil. You see? So anyways, oil's down. Are you going to buy it? Well, that's what you should be deciding. That's what you should be deciding. Okay, gold. Well, we'll see. S&P 500. Ooh, what a bad Friday, huh? Some will say, "Oh, it's bad earnings from banks on Friday." Or I'd say if you looked at your chart, it just said it was going to do it. So it did it because it was going to do it. Or maybe a combination of both. But whatever you believe, as long as you have a belief system. And well, definitely a breakdown going on in euro dollar, meaning dollar strength. That is definitely risk off. This moved sideways for 5 or 6 weeks and now break out to the downside. It's happening. It's real. Hopefully, you're not frozen in time. And Bitcoin up 3.5. Yeah, sounds good. It was 60 apparently on some of the platforms. Um, but now it's up to 66. So I guess it's up, but it's kind of weird because I owned it late last week at 70, you know, and I left my room to change my mind and came back and yeah, suddenly it's down $10,000, right? Like, oh my God. So it says it's up, but my books, it feels like it's down, but it's up from 60. So, anyways, wow. Good luck with that. Okay. And one tick to the off. right? The risk off. We'll do the scatter plot a little bit in a bit. Looking here, dollar strength, dollar strength, dollar strength, dollar strength. What do you think? Dollar's very bullish across the board. And for those that have the AI alert service as an upgrade to QuantBox Pro, you got emails and text messages over the weekend alerting you to these changes and why they changed. Okay. Dollar strong, dollar strong, dollar strong, dollar strong on the sell side. What do you think? Dollar strong? Yeah. Could be a rabbit, could be. Okay. And risk off. Risk off. Are you risk off? And typically, this is the typically table, the typically table. In a scenario like this, you would buy dollar, you'd buy yen, you'd buy Swiss franc. That's just kind of where you start with. Yen right now is still being impacted by their central bank, so I'm not as sure this time around. Okay. So you got to choose. Well, that means maybe there's some dollar strength. Well, we just saw across board there's dollar strength. Okay. And Swiss franc might be strong. Well, it was weak. The central bank did cut interest rates. Therefore, it did weaken its currency. But maybe it's a new world if the S&P 500 is going to drop for 6 months. Maybe it's a new world if war will break out in the Middle East. Things have changed. That's why we look at this stuff. So maybe Swissy gets strong despite that. Maybe it's perceived that Swiss National Bank cannot cut further. So it's just not weak. But we want to see in a risk-off scenario, capital flows could move from Great Britain or Europe towards their Swiss bank accounts. Okay. So that's why we want to look at all of this. This is the underlying intrinsic trend. Just sort of like euro dollar moving sideways for about 5 or 6 weeks. This moved sideways for 5 or 6 weeks. But in today, okay, as of right now, there is an underlying intrinsic trend. It's hard to see these things. You might say, well, the dollar's strong, Wayne. I can see all that. Uh-huh. And the stock market's down. Uh-huh. Yeah, I got that. But VIX is up 10%. S&P 500 down 1.5. Okay. Yen not going anywhere. We're plotting that. Okay. Gold up. I don't think that's good. Okay. Dixie is up. Right. Dollar index. I don't think that's good. And yields are up. And I don't think that's good. The reason I say I don't think that's good is I made this table. There's no like some secret sauce going on in the math of like, why, whoa, why should you be bullish on yen if if the central bank of Japan is doing X, Y, and Z? Well, I'm just saying, in my experience, that's how I think. You can disagree with some of these, but most of these, if not all of them, like I think really the one you could disagree with is gold, and you can flip it on the other side. Okay, fine. Just adjust your score. Okay. But this is sort of my opinion of the correlation of these assets. But nonetheless, volatility is up dramatically month over month on VIX. Okay. Yen has lost. All right. So, a little bit mixed bag, right? Because remember, it's looking back for 30 days. Gold is up. I don't think that's good. Dollar's up. I don't think that's good. Yields are up. I don't think that's good. So, look, I wouldn't recommend being a bull. Now, you might say, well, Wayne, I love to buy this giant dip. Well, you do you. Okay. I'm looking at these markets and saying, right now, there is no doubt that there's risk off going on. And I should In my opinion, I look at this and say, well, maybe I should go along with that. Or if I am a bull, step aside and wait for the opportunity because it'll probably drop further. Use it, use it the way you want. Remember, it's a tool. It doesn't make decisions for you, right? If only your speedometer made you slow down. Although they do have cars that do that now, right? Apparently in Europe. Oh, and I hope they don't do this in America. Soon as you hit like a certain speed limit, and I don't mean a million miles an hour, right? I think you hit about like 140 kilometers, and your car will just scream at you, "Bing, bang, 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 bang." You can't turn it off. Like, yeah. Well, guess what? Used car sales are going to go up in Europe. Any car that doesn't yell at you while you're doing what you want to do, anyways. So that's the American way. Okay, Bitcoin up, but remember it was down. So I'm going to get rid of that because to me it's an illusion. It, if it was, if the last time I looked at it was 70 and now I look at it and it's 66, it doesn't seem like it's up 3.5%. So, anyways, that's just because it trades 24/7. Anyway, all right. So let's look. Stock market down, commodity down, stock market down, stock market down, commodity down. Stock market up. Oh, that's interesting. In fact, let's just look at indices. Oh, interesting. Wonder if they'll come around. Now, Nasdaq's been hanging high because of those magnificent seven. I think. Well, I don't look at equally weighted. Um, I can't go back and forth. I guess I could. Um, I suspect equally weighted is down, but the Magnificent Seven's hanging up. And is it wrong? Well, normally I in a scenario that we're in, like where Dow is down and S&P 500 is down, I would expect Nasdaq to be down. In fact, maybe even down more. So why is this hanging up? Why is it breaking the normal pattern? Well, those seven companies happen to actually be printing profits. They're making not their cash flows ridiculous. I mean, like you'll take Nvidia now. Nvidia is down, so maybe you can buy the stock at some point. But when you make a product and you triple the price, and not only do you sell every single unit of product, but you have customers screaming at you for more. That's a pretty good business. you know, that's a pretty good business. I bet you Elon would like that for Tesla right now. Apparently, they're going to lay off 14,000 people today. Yeah. Well, you know what? Maybe they've hit a point of maturity in the company. Maybe it's no longer a growth stock. Maybe it's mature. Even around Georgia. There's Teslas everywhere, right? It's amazing now. You're like Tesla, 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 Tesla. So anyway, so can I grow at 40% a year if everyone that wants a Tesla already has a Tesla? Yeah. I don't know. My friend has been waiting for his Cybertruck, but he ordered the Beast. You guys know anything about this? It's not a Cybertruck. It's like a Beast version of the Cybertruck. He ordered it like 4 years ago or something. Still doesn't have it. Sounds pretty cool. Taking a look at the majors, I guess. Let's do this. Wow. Whoa, whoa. Look at USD yen. Okay, well, it's hard because this is really flat. Look at the actual absolute return, 0 to 0.4. But USD yen right? USD yen is very, very bullish. And over the weekend, I got messages from QuantBox on my text. I got text messages. Okay. My quantitative analyst worked the weekend for me and noticed things like change in retail sentiment. We've known institutional, but retail's turning this way now. And well, I got notifications on my cell phone. Thank you, QuantBox. Anyway, so I think that this looks overblown because when we add some other things to it, you know, there. Okay. But look at yen weak, yen weak, yen weak, yen weak, yen weak, yen weak, yen weak. Okay. Normally, as I was saying, in my 20 years of experience, normally in market conditions that we're standing in right now, whether it's long term or just short term, doesn't matter. Current market conditions typically create a situation where Japan is a safe haven. So now when we look at this, how can we interpret just the yens? If we're just looking at the yens, Japan has lost their reserve status for the first time I've seen in 20 years. Did you see that? That's what that says. No, but it's pretty cool though, right? Like we can see it normally. And you're like, Wayne, but only the dollar is a reserve. Well, it's sort of a de facto, like when I started, and then of course, even before me, going back decades before I was a trader, Japan was considered the center of well, let's just say the Asia. There was no China, right? China wasn't a player globally. It was all about Japan, especially if you're talking about the 80s, right? And therefore, business was done in yen and dollar. Now, dollar was the reserve currency, but you know, Japan, Tokyo, right, was the center of the financial universe in Asia, and lots of deals got priced in. It was really important. And remember, the palace in central Tokyo, which is only I don't know what 25 acres, was worth more than all the real estate in California. So it was a big deal if you think about it that way, right? And so when things were bad, you would park your money in yen or dollar or Swiss franc. Why? Switzerland was also a financial hub, but for Europe. Okay, so you had the de facto global reserve currency, and then sort of like the secondary reserve currencies. When things went bad, you took your money out of investments and sent it back to your Swiss bank account, right? So, anyways, well, this is interesting because it looks like risk on. Okay, it looks like risk on, but we know we're not risk on. So the yen being weak right now is a major thing. It's huge. It's huge. Could be the end of an era. I mean, a era since probably I would guess reconstruction of Japan would have taken at least 10 years, so to 55. So probably since 1965 to today. Today just ended a run on that status. Pretty interesting. So be careful. I might have to change my risk gauge. You see, it's that important. All right. So let's plan our week. I think we have retail sales, don't we? Let's see. We'll find out. Yeah, retail sales. Nice. Okay. That's at 8:30. The question that's on the market's mind is that since we are now what in the second or third month of inflation returning, is it impacting consumers? Okay, we'll find out. Eventually, you would think the consumer would slow down if they don't have any money, they don't have any credit, and prices are going high. But maybe credit's easy to get. I don't know. That would be a question. Maybe people have lots of money in the bank, That'd be another thing to research. Now, in I think our situation in the United States, you're getting a greater financial divide. I think you're going to have more and more people with no credit and no money. And where did it all go? To the other people that now have much more money than they used to and have converted that into assets. And you say, well, that's, because filthy, stinking capitalist pig dogs, right? No, no. That's what happens when the government prints money, because there are two types of consumers, ones that spend money and ones that own assets. So when you look at GDP, okay, no, I won't go into the long speech. I can feel a long speech coming. I won't do a long speech, I promise. So you look at GDP, you have consumption, you have investment. Okay. This Consumers can choose what to do with their excess capital. So you need money to pay your rent, you need money to buy groceries. Gotcha. Gotcha. Okay, we call that the CPI basket. But typically when you have excess capital, you can go out and buy a TV, okay, or you can go out and buy stock. You can rent your apartment or you can buy your apartment. Okay, these are just simply choices. Now, the government also spends and foreigners also spend, but we'll keep it very simple here. So, that COVID money, right? Eventually, if you spent it all, it's gone. So, where did it go? If you spent it at Applebee's, Applebee's. I don't even know how to spell that. Is it like that? I don't know. All right. Guess what? So you get your COVID cash. COVID cash. It's pretty cool. COVID cash. All right. Some people will have spent it here, but then wealthy people didn't need it and they still got it. You still got, even if you didn't need it, the government gave you money and it was weird. So you're like, oh, I don't need this money, and I certainly don't need eat at Applebee's, right? So, but I own Applebee's stock. Okay, so people that spent it on buying, let's say, the stock market, or literally Applebee's stock, or whatever, or you own the apartment building, that kind of stuff. Guess what? The cash ends up there. All of this cash. All of it eventually goes to people that own the assets, and you get income inequality. Income inequality is horrible. Okay. I think Republicans care about it less. Democrats care about it more. It's definitely uh, a response to monetary policy. But you might ponder on this question: who created most of that spending? Who created most of the money? And then, anyways, I'll leave it to you to figure that one out. Right. So, anyways, let's go back to the economics. So, what I was saying here is, does the consumer have money or credit, or are they going to stop spending? And it'll be interesting at the point where um, people that go to the mall to shop suddenly stop going to the mall to shop. I don't even know if people go to a mall to shop anymore. I heard in New York City they closed an entire mall because mobs of people just walked in and stole everything from the entire mall. And every retail shut down. I'm like, oh my God, I wouldn't want to own that mall. Yeah. So, anyways, we'll see. The consumer's important to the elevated stock market prices that we've had for a while, because that money was getting spent. But remember, the more you spend the money, the more it eventually will end up into investment by wealthy, and then it will be taken out of the economy, right? What else going on? Okay. Yeah, okay. CAD news. CAD CPI, I suppose. CAD's in a world of hurt. Really bums me out. Even my cousin, I was talking to my cousin. I'm like, you gotta come down. And he's like, dude, it's hard here. It's literally, he starts telling me the sob story. I can hear like the violins in the back, and he's like, oh man, things are hard here. And then if I gotta head down and pay, $1.40 for everything, and I'm like, dude, you don't need money if you stay with me. Just bring rye. Bring rye. Yeah, and he's like, I might have a deal going on. Yeah, I might negotiate a good deal. Get some Canadian rye whiskey, so it'll be good. Um, yeah, okay. Inflation out of New Zealand. Yeah, that'll be interesting, especially if it goes up. I mean, look at this. Even I skipped a little bit. Like I look, I don't want to. I don't want to see the Canadian news, but anyways, expected, right? It was 0.3, but now it's 0.7. 0.7 month over month is cray cray. That's crazy. That's crazy high. Usually when you talk about month over month CPI, you're like, oh, well, 0.2, like 0.7. What is that? Okay. So, ouch, ouch, ouch. Then we got CPI out of the UK. Okay. Later that evening, okay, Aussie jobs. That's a great scalper. Okay. Every time I see this, I'm reminded that I trade that one uniquely. I scalp it. And the most famous story, or at least the one in my brain, I don't know if you've heard this one. I'm in New York City at the Bull and Bear, the old bar at the Waldorf Astoria that JP Morgan used to hang out. And I used to hang out there. And I got to the point where I could walk in, which is cool as a visitor to New York City. You walk into a bar and the bartender waves, gets rid of some tourists, gives you a bar stool right at the bar. Loved it, right? So anyway, so I'm there having my cocktail and even eating my steak at the famous Bull and Bear. And then I'm like, because it's late, and I look at my watch. I'm like, I got to go. Aussie jobs report. I got my wine, a whiskey, and a steak at the bar. I'm like, I'll be right back. And they're like, well, where are you going? I'm like, I got to go up to my room. There's going to be Australia's announcing their job report, and it's going to be greater than expected. I'm going to catch a trade, and then I'll be right back because I won't be in it more than 10 minutes. I'm like, really? Yeah. So anyway, so I leave and I go up the elevator, and, right? I go in there and go in. Greater than expected. Aussie moves, spikes 100 pips, grab it, cash out, go back down. They're like, how'd you do? I'm like, nailed it. And they're like, I always think that, like that, because the next thing is, then eventually go to sleep. You wake up in the morning. What happened to that 100 pips on the Aussie? I think it was an Aussie dollar trade. What happened to the 100 pips? It came all the way back. So if you'd stayed in it, you would have got nothing. So it's always in my brain. To me, that's a scalp. That's a high volatility event driven strategy, right? And to anchor it like that, I think is important. Maybe it's dangerous if it's no longer true, but we have QuantBox, so we can figure that out. Okay. So, anyways, so could be interesting there. Um, you know, especially if this pops into a four handle, if moves greater than expected. Okay. Um, that might actually be good, which is weird, right? Slowing their economy down. Thursday's thin, just weekly jobless claims, yada yada yada. And then if you trade pre-London, you got to trade on retail sales out of the UK. Okay. If I'm personally trading London, I'm at my desk at 1:30 a.m. usually in a trade by then. So I guess if I'm trading London, I'll be at my desk at 1. Try to be in the trade by 1:30. And it's because the news comes out at 2 and the market opens at 3. So if you're going to front run that sucker, catch an Asia fade. That's how you play it. Cool. Interesting week. A little bit of CPI, huh? Again, CPI, CPI, CPI. Okay. I skipped China's industrial production. That is actually a pretty big deal. Let me address that now because this comes out tonight, and it looks like the market expects a lower number. So if it's not lower, if it stays about 7 or even goes up 7.5 instead of 6, that's a big differential. Watch oil. Okay. You might catch an oil trade. Wink, wink, nudge, nudge. Psst. Hey. Do you want some oil? Yeah, if you were watching Sesame Street in the 70s, one of my favorite ones was this guy. This guy that was selling an O. Hey, would you like to buy an O? It's so strange. And it was a guy wearing a trench coat. This is Sesame Street. And he would open it up and he's got like fake watches and stuff, but he also will sell you an O. I'm like, it's so strange. It was the 70s though. Like strange, right? Strange. So I don't know. How much is your O? How good is your O? So strange. 1970s. All right. So look, here is the stock of capital. And yen is weak. Nobody wants it. Even in a scenario where maybe, well, you used to, let's say, want it. Interesting. Russell, whoa, what? Copper. Hey, you're welcome. Isn't that nice? Anybody upset that we added copper? Russell, this is small companies. This is a balanced portfolio. This is growth companies. Cool. Platinum and copper. Copper is a great risk on, risk off gauge. They call it Dr. Copper. It tells you what's going on in the market. If the economy is expanding, do you think we need some copper wires or copper pipes, for example? If you're building more skyscrapers, you're going to need some copper. Although that's not even true anymore, right? Yeah, when we redid our basement, I brought in a really good. I was really impressed with our plumber, and they pulled all the copper out and they put in these beautiful flexi flexi pipes, and there's a red one for the hot, and there's a blue one for a cold, and I'm like, it's so nice. I was so happy, right? I'm like, it's so happy. And then, of course, we don't use copper for our phones anymore. And do we use copper for our internet? No, everything is glass now, fiber optic, right? Or waves over the sky. But anyways, copper, we got it. Right? It's pretty cool. So this is expanded a little bit. And now we can track whether copper, again, if copper is falling, typically, okay, typically, especially let's say 10 years ago, 15 years ago, 20 years ago, how would you look at that copper? Copper up, risk on. Now, this data is fresh. It's the freshest, cleanest data we have, issued by the Commodities Futures Trading Commission.gov. We pulled it right out of their database. But they put it in their database on Tuesday. Well, they gathered it Tuesday. So by Tuesday at the close, Wednesday morning, the government had all the data that's going to be recorded. And for some reason, they wait till the end of the week. I guess there must have been a time when people did it with pen and paper. But they release it Friday at the close, and then QuantBox updates. And then again, if you have the AI alert service upgrade to your Pro account, you get a report emailed to you. So you don't even have to log in, and it only tells you what's interesting. But nonetheless, this does not reflect the geopolitical tensions. Okay. And it doesn't reflect the the do we call it a crash? The 1.5% decline in the stock market on Friday. Friday was a doozy. Okay. Not only was it down, it was straight down and it closed down. I can see it in my mind, right? The stock market, giant red 4 hour candle, followed by a giant red 4 hour candle closing down. Like that's that. It was down for 8 hours straight. Okay. So, does it reflect that? No. So, like platinum up, NASI up, copper up, Dow up last Tuesday. So, I don't know. I don't know. I don't know. I don't know if I believe this. I don't know if it's that way anymore. I suspect it's not. So, we can look at those flows. This is what is going on when there's a risk on attitude. Okay. So, but then maybe you want to look at the balance here. NASI's 50-50. Wait, I remember when NASI was like 80% long? It ain't now. Okay. Not much, even though this is up, not much new money. Basically, no new money long. So, what happened last week is people got out of the short and they could probably get back into the short without any duress. Okay. So, what else could we look at? Still 70% long on the Dow? That seems heavy. Dow has really been crushed. It's the worst of them. Euro 50-50. Okay. 67%. Let's just say 2/3 of all investors are short. Look at this 1 million contracts, meaning they believe the yield will fall. So we're at 4.5 ish. And 2/3 of the market have invested as if 4.5 ish will be the high. And that in 2, 6, 12 months, yields will be lower than they are now. I'm positioned that way as well. So I'm part of the 67. S&P 500, 50-50. Dollar 50-50, but that's probably changing. Okay. Well, it wasn't at the time, but it probably is now. So don't kind of use this to make your decisions. Just try to figure out what the psychology was at the time. And would that psychology have changed? Would the market conditions change your opinion of selling New Zealand dollar? Would the US stock market decline and dollar strength, US dollar strength, would that change your mind about Kiwi? No. So the market hates the Kiwi right now. So then you're like, well, if we're risk off, as QuantBox is telling us now, remember the risk gauges are now. This is last week. So if you're like, well, if now we're risk off and if now the dollar's strong, but in general, the market hates the Kiwi, what do you think about New Zealand dollar down? Okay. Look at this. Swissy was crazy weak because back on Tuesday, We had a Swiss national bank cutting interest rates. Totally makes sense. You should have been selling the heck out of that. But things may have changed. I would say have probably changed. If you look at your charts, you'd probably look at it and say, oh, yeah, they've definitely changed. So you should be able to read these numbers and say, okay, then that makes sense. But now these dudes, these chicas, got to get out of these positions because money is probably flowing to Switzerland. And we see that in the risk gauges. So just say these guys have the most to lose. So the velocity, the change of money going back to Switzerland is probably quite high. Okay. The market's hanging in on the pound. Okay. They're hanging in, still 60% long. CAD, people don't like CAD. CAD's hurting. Hey, inflation is going to go from 0.3 to 0.7 in 4 weeks. You're like, wait, inflation's going to double this month? Yeah. Well, money's not going into Canada. Boo. Okay. Boo. That's right. But anyways, that's happening. That's a fact, Jack. Okay. Less buyers and less bears. Like, just people don't even want it anymore. Wow. Oil's still 70% long. So are you going to buy a dip? Have you lined it up? What do you think about 85 or 84 or 83 or 82 or 81 or 80? Do you think it's going to stay above 80? Do you think it's going to come down or near 80 and then what? Be at 100 around June or July? Have you looked at the oil seasonality? Is this the right time to buy dips? Okay. Right. It's harder to say, why is it coming down with geopolitical risk? Now, I say things like, well, the consequence to that, if tensions go up, is that then Saudi Arabia will increase output and all that, blah, 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 blah. Don't get caught up in any of that. What you should do is say, are you going to buy the dip? And will it be higher in 2 or 3 months? And make that decision, and then go to your chart and do technical analysis. And the technical analysis will tell you the price and the time. But you have to make the decision before you go to the chart. Uh-oh. Is that not going to work for us? Let's try the Kiwi dollar. See if this pulls up. All right. Developers. You have to tell somebody, hey, if you're going to make a list, do it in alphabetical order. Well, you didn't tell me to do that. Developers are like kids, right? Like, I told you to clean your room, put your clothes away, put your laundry away. Then they're like, I'm done. Can I be done? I'm done. You're like, well, you put your laundry away, but there's clothes everywhere or toys everywhere. Put your toys away. Well, you didn't tell me to put my toys away. Uh-huh. So, anyways, I'll get off my ramblings. All right. First one is Kiwi. Asset number one, long minus short. Oh, cool. Glad I did that. That's neat. Okay, so we're looking at this is simply the New Zealand dollar. And it's telling you there are more bears than there are bulls. Okay, the downward slope from here to here. I guess I should get my drawing tool. Delete, and I'll make it black. All right, so this move here shows you the direction. What we're looking at is the number of longs minus the number of shorts, as referenced here. Long percentage minus short percentage. And when it drops below 0, it tells you there are more bears than there are bulls. Isn't that nice? I bet you don't use this though, right? You're like, I don't even look at that. Well, this is why we do this every morning, right? And you're like, oh, well, maybe I should play around with this. Yeah, play around with it. It's cool. So with New Zealand dollars specifically, there are more bears than there are bulls. Done. New Zealand dollar is bearish. Remember that time when we, we've all been there. We struggled with our bias. Should I be long or short? Well, the market's short. Why don't you do that? See, it's not even an opinion anymore. The market is short. What's the big deal? Okay. Then you're like doing comparative analysis. So now we want to look at asset number 2, which is dollar. And the market is, we'll call it neutral as of Tuesday of last week. So if suddenly it pops up, you know your game on. Okay. Now put this in your mind as far as correlation. Okay. We've been risk on during this period, right? The US stock market rallying since November of last year. Dollar weakened, right? I bring this up because most people have this wrong when I meet them as traders and investors. They think the stock market up, dollar up. I'm like, no, 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 that's not true. And even in the media, they get this wrong quite often. I'm like, no, no, that's not true. I've never witnessed that. So the dollar weakened, oops, in a period where the stock market went up. And that makes sense. So if suddenly we have a risk off, we don't know the future, but if it's suddenly risk off, expect the dollar to rise. Cool, right? Nice. So what does this say? Kiwi dollar short. And in that instance of last week, it's only mildly short. But if suddenly the US dollar goes up, Kiwi dollar will accelerate its down. Okay. And why is that important? Okay. Kiwi dollar could be negatively impacted by a bad number out of China. And we have CPI news, right? So the next 2 days, Kiwi can be impacted. It could even be impacted by, you know, uh, the Aussie economy slowing down. You could then extrapolate and say, well, Australia and New Zealand do a lot of business together. And if Australia starts slowing down, they might do less business with New Zealand. So you might have a lot of Kiwi action today or this week, right? Or at least the first half. Cool. So dollar strong, dollar strong, dollar strong, dollar strong. Come on. No. There we go. Dollar strong, dollar strong, dollar strong, dollar strong. Stuff lurking in neutrality. CAD down. CAD down. CAD down. CAD down. CAD down. CAD down. Okay. A lot of bearishness on kitty CAD. That's a good start, I think. And check this out, especially if you're trading in Australia. Iron ore, Ethereum, copper, platinum, the Russell. Okay. Cool, right? You're welcome. Isn't that nice? Oops. Okay. USD CAD last week got decimated. Copper up 1.5%. That's nice, right? Hope you don't mind. Okay. Bitcoin was in the high 70s, or not high, low 70s, and dropped quite a bit week over week. Small stocks, that's what the Russell is, small and medium-sized businesses, had a bad week, down 3%. The Dow, which are giant multinational corporations, were down last week. The S&P 500, which is a balance between value and growth, was down 1.5%. And then our NASDAQ, which are growth stocks, was flat. So the best performing US stock market between small cap, large cap, value, and growth was growth, and it didn't change anything. Feels pretty heavy, right? Again, I picture the ballerina standing on her tippy toes holding a bowling ball over her head. It gets heavy, and the down happens fast, right? It's hard to lift that bowling ball and stand on your tippy toes. It takes a bit of effort, but boy, coming down is faster than going up. So be careful. Am I worried? Yeah. Now I've structured my retirement portfolio, my pension. I'm structured to handle this, but it's sort of like the duration. I think if it comes down, I think it can come down for 6 months. So it's more like, well, I can handle, let's say, the down, but the volatility I may not want. So, what do I do on some of these things? And should I hedge or should I go to cash? And I'm like, those are very good questions. And QuantBox helps me address those questions when I do my research. So I can go to things like seasonality, but then think about it in the context of how this year, which is a very unique year, could be similar or different than, let's say, average years. Okay. What a cool paper to write if you were an undergrad student, right? That'd be a great thing for me to ask you. So we'll look at copper, and I want to show you how to use this tool. It's a I used to pay for something like this. I think in the old days I think it was 300 300 a month, 200 a month. And then nowadays you can buy this from various sources for about, I think $30 is reasonable. I can get this from a couple other sources, probably for about $30 a month. Well, it's built in QuantBox, but anyway, so copper over over the last 5 years has a good first quarter. Okay. I should do it in color. Okay. That's 5 years. And then in green, you look at over the last 20 years. Okay. So over the last few years, you've had a steeper up in the first quarter. in the last 20 years, it's just a less steep, flatter, however you want to describe it. And then this year, what actually happened? It came down and then it went up. Do you feel satisfied? Did QuantBox do its job? I would say so. And we don't know the future, but we know the past. What does the past tell us? What's the most likely path for copper? So if you were making a boatload of money, typically you would want to take some profit now, right? And let it fade, or you could sell it if you want. Now, the difference between this year and other years, there's a few. There's the election, but in the back of my mind is really inflation rising. So in 20 years, how much inflation do we typically have in the United States? Boris says the plot shows the change, though, right? Um, I might have missed your question, Boris. Let's see. Uh, so it's going to go up. So I think we were looking at something else, right? But hang on. I don't know if I can follow that. Hang on. Let me follow through on this, and then I'll try to address that. Okay. Maybe try asking it again while I talk. Ask it in a different way so I can click. All right. So we have more than right. Inflation is usually zero-ish. We haven't had an inflation problem for a generation. Okay. Oddly enough, the last time we had inflation is when we had a central banker that wasn't an economist. The head of the Federal Reserve Bank and the Board of Governors, his name was Burns. He worked for Jimmy Carter. And Burns was not an economist. And we had high inflation that was persistent and stubborn, and no matter what the Fed did, it wouldn't stay down. And now we have that problem again. And oddly enough, Powell is not an economist. Quite an interesting coincidence, right? All right. So, anyways, let's look at this. So suddenly, so 0% ish, and now we have inflation, right? And typically, if you were going to be in an economy like stagflation, let's say, I'm not saying we're there, but let's just say you were. The economy wasn't collapsing, but we had high prices. You don't want to own the stock market. You don't want to own financial assets. You don't want to earn bonds that pay you the old inflation level while inflation's higher, right? So if you own a 10-year T note paying you 4.5, but in annual inflation was 7, you're losing, right? So what's the value of that bond going to be? That treasury is going to be, down 30-40%. So in that typically what you want to buy is physical things. Food, copper, gold, real estate, that kind of stuff. Tangibles, not financials, right? Financial assets. You're like, well, I own a piece of paper that says this company is going to pay me. That's a financial asset. People want like, right? So anyways, that's interesting. So this year you could get something like this, something different than normal. So that's how you need to read through it. Like, again, this doesn't predict the future at all. In fact, this has never actually happened. Think about that. Why has this never actually happened? These are averages. Okay. So let's say like this dot, let's say 50% of the time it went up and 50% of the time went down, then that's the dot. But it was never, if half the time it rose in that month and half the time it fell in that month and there was never any in between, then that dot never actually happened, not even once. You get it? Like, it's some abstract concept that humans made, right? The deer that walk through my yard, they're not calculating averages. They're hungry. They're hungry on average, right? So, anyways, yeah. So, anyways, so you got to be careful. But okay, let's see if I can get this. Okay, on the vertical axis, you have the percentage. Yes, percentage change. Yes, in price relative to the price in the beginning of the year or relative to price in previous. It would be the normal. Yeah, it would be month over month. So maybe this helps you. Yeah, it would be, well, you know what? This is probably annualized. I say I don't look at it like how much it's going to move. So I guess I just kind of answered it, Boris. I don't look at it as this is going to change 6% month over month. No, this would be 6% from zero. But I don't look at it like, okay, so at this point, we have so much change that we've fulfilled that 6%. So now we want, no, no, I don't look at it that way. You could. I look at this as the shape. Okay. Now there's two things. This is the month, right? This is the uh change. Here's the week over the week. Right. This is, so I don't believe, I'd have to really think about this. Is this 6% greater than the 4%? Well, it did start. Yeah. Why are you saying there? Well, this one does start at zero. Um, Another way to look at it, this is what I've done here is try to address. So let me think through this. So I'm looking at sort of the shape and the month over month. So so this starts at zero, and this it was already up. Okay, and then so you have to realize too, this is a continuation of this. So you almost want to shift this over in your mind, right? So if you started buying copper in September, October, is you start your accumulation phase. Okay, it goes up in November, December, January to February, and right now you'd probably be taking profit. Your year as an investor is over. Which wouldn't this be great though? Right? Soon as you're opening your swimming pool for the year, you're like, I'm done working. Right? I stopped trading copper when I opened my swimming pool. Um, so which in my part of the world is actually probably the third week of May. But so you're looking at this. This is even earlier than that, right? You're like, oh, I never work past Easter. This is the accumulation building up positions week over week. So maybe this helps, Boris, in what you're trying to get to. Uh, okay, we had a buyer, and then a seller, and then So right, so all the bulls and then all the bears and all the bulls and all the bears and right, and then it was really it's quite bearish in the beginning and then it accumulates up, continues accumulating up, and then right drops by week 24. That's kind of the peak of the year. Week 25 to week 42. 25 to 42. The market is not accumulating positions. And then they accumulate positions here. So the way I look at it is really by week 38 or 39, I should be buying these from these selling. This is selling. This is more bears. It's the accumulation of negativity, right? So there's more and more and more bears selling. So I want to come in probably here 38, 39, 40, 41, being prepared to be an accumulator. And then this is okay. This is other people getting on the clue train, and this is me getting paid. But then that's total, right? Total. And then we start again at zero because it's the accumulation, right? So that's where like you can see here the accumulation continues. Okay. Okay. I put here too in the seasonality of this. This is just 1 week, week after week on its own. And again, this is average, which never happens. So it just kind of gives you um, a visual clue to reasonable normality. Okay. And then I put two standard deviations here to show you in your kind of like phase of lining up whether you should be a buyer or seller. Let's say in the first quarter, you're fundamentally a buyer of copper because of this. Okay. This this analysis can show you that right you can buy a drop in January. It's okay. And it actually happened. And part of the analysis is not just the red or sorry, right, this kind of stuff. Um, it's coming down, but it's the fact that week 5 is 2 standard deviations below what normally happens to copper throughout the year. And that would be a buy. That's why it's green. Okay. So you're like, huh. And then look at on the high side, 2 standard deviations above. That could be a sell. At least you could look to sell. Oh, wait. You see? Like if you were already looking to sell because of this, and then the chart rolled over on your chart. This is just seasonality. So if you had a chart and you're trading copper and you're like, over the next 2 or 3 weeks, I'm going to look to sell because traditionally seasonality, this gets overbought by 2 standard deviations. And then you can plot this out and say, and it could last for 6 months. So that might be a market capitulation point, the peak. And you're ready, willing, and able before it happens. Okay. And then what? Week 25 is interesting, way below 2 standard deviations. Okay. Now look at this. You're like, well, it continues down, right? Yeah. But I also think in my mind as a trader, this is usually when I cut my trading volume by 50% or more. And well, being a Canadian white male, I have a body of a hot water heater. Um, so that's a great time to go out and get some sun right? Get some sun on my skin, get a tan, and spend a lot less time trading. So this could be a drop. Does it mean buy? Maybe it's dropping because everybody's taking profit. And then you come back to the market, and maybe it's just doing nothing in this period. And then when should you come back into the market as a owner? You want to own this maybe, right? Well, again, we already identified this week 38, 39 is somewhere in here. You can spend the next month slowly accumulating using technical analysis. And then you're like, man, not only am I going to buy copper when I get reversal patterns pointing up off of support, aka not only am I going to buy higher lows in copper, well, I can keep this accumulation phase going, okay, as far as March, April. Okay. Now, Boris says, does that reflect some kind of manufacturing cycle? Probably. Okay. Probably. It could be mining cycle. It could be a distribution cycle. It could be orders coming in for copper. Like let's say, let's just isolate this as North America. Okay. Because this is US futures, right? So let's say this is the time of year you build skyscrapers and houses. So when do you want supply of copper to be at its maximum? When do you want supply of copper pipes and copper wires and copper anything? When do you want the supply to be at its peak? So people that make brass fittings stop making brass fittings there. Their warehouses are full. And then they go into the sell phase. Sell. Not selling, literally selling copper pipes, copper wire, copper fittings to people. And then, right, the building season ends in the fall and you got to rebuild all your inventories. So supply of copper stuff is high, and then copper stuff is low here. And we build the cycle. Are you guys glad that I added copper? Yeah. Well, prices are going to go up 50% because I added copper and Russell. No. It's just there. Compliments of the firm, everybody. Dr. Copper. You're like, well, I don't know if I trade copper. Well, if you live in the United States and are going to trade a prop firm, chances are you're going to be trading futures instead of cash. And there all of a sudden, you're like, well, what if your prop firm suddenly has copper futures? And you're like, oh, I have some inside information. Well, it's not inside information, but what percentage of retail Forex traders have this level of data regarding the copper market? Zippity doo dah. Yeah. So you have an unfair advantage. Cool, right? Yeah. All right. Well, that was a long one. I got to go. I got to go do Forex today. But there you go. I didn't expect we were going to talk about copper this morning, but I hit you hard with copper. Yeah. So, well, I apologize for that. Yeah. Is it copper and then you add tin to it? Does that become brass? Oh, no, that's bronze, isn't it? Bronze. Copper plus tin equals bronze. Yeah. Anyways, I'll see you when I see you. Peace on earth. May the pips be with you. May your profits be above average. May your profits. I we should name a town profits. I'm the mayor of profits, right? Yeah. Anyways, mayor profits be above average.